Welcome to the Financial Planning for Canadian Business Owners podcast. You will hear about industry insights with award-winning financial planner and entrepreneur Jason Pereira. Through the interviews with different experts with their stories and advice, you will learn how you can navigate the challenges of being an entrepreneur, plan for success, and make the most of your business and life. And now, your host, Jason Pereira.
Hello and welcome to the Financial Planning for Canadian Business Owners podcast. I'm your host, Jason Pereira. Today on the show, I have Cato Pastoll, CEO of Lending Loop. Cato came in for a conversation today about personal and business credit ratings, as well as talk about what he does at Lending Loop, which is an alternative lender to small businesses. And with that, here's my interview with Cato. Hello, Cato.
Hi, Jason. How are you doing?
Good. Thanks for coming in.
Thanks for having me.
So Cato Pastoll, CEO of Lending Loop. Tell us about Lending Loop.
Yeah, so Lending Loop is an online marketplace lending platform. What we do is connect small businesses that are looking for an affordable source of financing with investors who want to lend money to their businesses.
You know, so I realized I brought you in for one thing, which is specifically talking about credit ratings, but we're going to spend some time at the end talking about your platform for raising money, because that is equally important to small business owners. So stick around for that. That's my incentive to sit around for the entire podcast. Like I said, first reason I brought you in was to understand credit scores, not specifically just personal, but the business credit scores, which a lot of people don't even realize they have, or if they do, they don't know where to find it. And they really just or have no idea what goes into it. So let's start off by talking about personal credit scores. What goes into that, and how do people basically best behave in order to make that happen? Make that number go up, that is.
Absolutely. So, personal credit scores are, now becoming more and more available, especially in Canada. I'd say over the last 10, 15 years, there's definitely been a lot more awareness brought to the market around what is a personal credit score, what does it mean, and why should I care about it?
Well, you get tons of free ones sent to you. I got 3 different emails a month now telling me what my credit score is.
Yeah, that is the case. And I think, with all of that comes more complexity too. I think sometimes people pay too much attention to what their credit score is, but at the end of the day, it is an important factor, because if you're looking for credit or you're looking to build a relationship with a supplier, credit scores do come into play. And so people should be aware of them. It's very helpful to have at least some awareness.
It's almost like a form of insurance. You don't need it until you need it. When you need it, you really need it.
Yeah.
And it can cost you for not having it.
Absolutely.
Yeah. So, let's talk about the sources for credit scores before we get into the free sources. We'll get to that. And I'm going to plug a couple other companies, not just yours. So basically the big 2 players, Equifax and TransUnion, right?
Yeah. In Canada, those are the big 2. Correct.
Yeah. And there's a number of free credit score reports you can get. So yours first, we're going to talk about. So the website for that?
So we have a website that we built recently. It's called getloop.ca. And that offers both consumer and business credit scores for free.
Excellent. And then there's other ones, Borrowell, Credit Karma is the big one out of the US, also came to Canada. Yep. But as far as I know, you're the only ones who offer a business one that I've seen.
Correct. Yeah. So in market today, we're the only provider offering business credit scores. And our focus was really on business. But, for a business owner, it's also important for them to understand their personal credit score, because that also impacts them.
Exactly. Especially given, every small business owner knows that, end of the day, you're going to take out a loan, you're going to be asked for a personal guarantee on most of this stuff anyway, right? So overall, again, 3 different places, and it's a benevolent little service you have there, because people can sign up for free to get monthly notices as to, go check their updates. So that's great. So you're using Equifax on the back end to score this. So let's talk about credit scores, what goes into them, personal side, how do people improve them? Tell me the story.
Yeah, absolutely. So I guess to start off with, there's kind of 5 main factors that impact your credit score. So if you're an individual, looking to say at your credit score and want to understand why it is what it is, the 5 things are firstly and most importantly, your payment history. So are you making your payments on time? Do you have credit facilities where you've demonstrated an ability, hopefully over a long period of time, to actually make your monthly payments and monthly obligations?
And we're talking about scheduled or minimum, right?
Correct.
Yeah. So every now and then I see people get into this habit where cash strapped of one than the other, because they're trying to pay off the entire balance. Not a smart move. Minimums at all times.
Exactly. Yeah. So the most important thing is that you're never behind on your payments. Yes. If you're behind on a payment, you miss a payment even by a week, that's actually going to really impact your score. Obviously, the longer the time that you miss it by, the worse it impacts your score. But the most important thing is that you're basically never late on a payment, and that's going to demonstrate good credit behavior.
And to be fair, not all creditors report if you're 31 days late, right? Like I find that generally the bigger credit cards, people miss a day or miss a payment by a couple of days. That doesn't show up on my credit rating. I've had that where I go on vacation and whoops, and then it doesn't. They're like, we don't report until 60 days, right? But some of the smaller lenders I've seen do that. So it's if it's one day, don't panic. Maybe call them and just make sure. But otherwise, it's not just make sure you pay on schedule wherever possible. For sure.
Yeah, I mean, I think definitely there is leniency applied by different lenders. And, but at the end of the day, if you don't need to take a chance, don't take a chance.
Absolutely.
That's always our advice to people, right? So, when you think about what your payment dates are, have them in your calendar or have pre-authorized payments coming out of your account, just to make sure that you're always going to be on time. Because why take a chance if you don't?
I mean, if you're not super diligent with your paperwork and payments, do something to basically automate that, because otherwise, or it's just going to hurt you. Absolutely. So what's next? What's the next big factor?
Next big thing is what we call utilization. So utilization is essentially of your available credit, what percentage of that are you using? So let's just say, you have credit card limits of $50,000. The important thing from a utilization perspective is not that every month your balance is $50,000. That means that you're fully maxing out all of your available credit. Usually lenders and the credit bureaus like to see utilization around 35% or less. That's kind of a magic number where they say that's a healthy amount of utilization.
So, and correct me if I'm wrong, that's usually done per credit facility. So if you've got like a student loan, a line of credit, and a credit card, and this is one thing that I think the credit scores are just dead wrong on. I mean, the smart thing to do from a financial standpoint is, if God forbid you're carrying credit card debt and you're carrying some other loan, the smart thing to do, as we always coach people, is to try to basically pay off the credit card as fast as possible and let the other one stay, even if it's maxed out. Right? That's the smart monetary thing to do, because you're minimizing interest payments. However, you're actually penalized for that from a credit standpoint.
I know it is interesting. The foundation of credit reports and credit scores is borrowing history, right? And it's kind of funny, that some people get penalized for not having a credit history and not having any borrowing history. I know that there's a lot of irony in that. As a company, we do our best to try to reward people for that. But absolutely, in the market historically, that is how people have looked at it. Is if you don't borrow money, are you going to be able to repay your debt?
But it's true. I mean, it's a behavior, right?
Yeah.
JP Morgan himself, the big man of banking for so long, when he was testifying in front of a Senate subcommittee hearing during the Great Depression, they asked him, what is the most important factor in lending money? And he said character. Right. And that's the old, 4 C's: credit, character, collateral. Yeah. And what's the last one? Capacity? Capacity, right? And they're like, the senator was like, surely, what are you talking about character? Surely it must be like their cash flows, or, how much they're putting in for collateral. And he said, no, I'd rather lend money to someone who went bankrupt but did everything they could to pay everybody along the way for as long as possible than someone who basically has all the money in the world and blows it paying everyone but the people they should. It's no comment on Trump there. Anyway, so that's something to consider. So even if you have, higher credit rated facilities on some, ratings on one loan than the other, know that unfortunately, if you keep the cheap one maxed out, you're actually going to hurt yourself a little bit. So it's a trade-off. It's a trade-off between credit rating and interest payments, unfortunately. Yeah,
it is. And at the end of the day, I think that lenders will also look at your overall utilization, right? So while it's on a per facility basis, it's also just as important to say, if my total available credit from all my different sources is $50,000, I'm only using 35% of that number. So I'm only using 17.5. Out of that 50,000, I'm not now borrowing 40,000 on a regular basis. Yeah. If you want to borrow 40,000, try to get your credit limit actually increased. Yeah,
sadly, you're better off with a higher credit limit and less use. And it's funny because I had to explain this to my wife when she was like, oh, we have too much every month. I'm like, we pay it off. She's like, yeah, but I just want to cut it, right? And just like, you cut it, you're going to hurt us. Like, stop doing that. Anyway, so what's the next one that comes up?
Yeah, the next one is credit history. So things that come into credit history is just around like your behaviors of using credit. So, when you think about borrowing from your different types of credit cards, like, are you actually utilizing more expensive ones or cheaper ones? So that kind of, we were just speaking about that from a utilization perspective, but from a credit history perspective, they also look at, what are the different types of credit that you might have. So for example, if you have a payday loan, that will penalize you more than having a term loan, a long-term term loan from a bank.
Yeah, I mean, it's just those types of loans. Yeah, I mean, long-term term loans, you're structuring them, right? Yeah. Like, you're basically committing to a schedule. Payday loans are highly punitive and typically are unfortunately indicative of short-term cash crunches, right? So, okay. So what's the next factor to take into consideration?
Next one is inquiries. So this is one that I think we've been trying to get more awareness to in the market, and I know a few other people have too. But if you shop around, so if you're going to look for credit in lots of different places, those will actually have a negative impact on your credit score. So
I apply for 12 different credit cards because I want to see what I can possibly get. That's what's known as, I believe, a hard hard hit to your credit rating, is credit score. Is that right?
That's correct. Yeah. So if you're ever looking for credit, one thing that we always advise people to check out is it going to be a hard hit or a soft hit? So just a little bit of a plug here for us. When we do an offer for a business, we actually just do a soft hit. So we have no impact to your credit score in order to offer you a loan. There's a lot of lenders, probably the majority of lenders will actually do a hard hit in order to offer you a loan. So that will actually impact your score just to know what type of rate you could get.
Yeah. So what's the difference from your standpoint between the hard and soft hits?
Yeah. So for us, we actually don't see soft hits. So the way that when we look at a credit profile, if somebody else has soft hit that business, we actually would never know. The only person that would know is the business owner themselves. So when they look at their own.
So at the end of the day, the lenders who go to lend you money have no idea if there's a soft hit done. And I mean, more often than not, and this, legislation has changed where we live, but like pre-authorized credit card, like pre-authorizations where they're like, hey, you've been, pre-approvals, where they send you, hey, you've been approved for this much. It's not because they're just randomly throwing one out there. It's because they hit your credit score on this soft hit criteria, saw the bare minimum information that comes with that, I think, which is just a score to my understanding, and then issued that. But that's not, or they, when they call you and say you're eligible for a credit increase, or now we have to authorize that in Ontario. But previously it used to be like, here you go, we just increased your credit limit. Oh, well, thank you. Okay. So anything else that they factor in, or is that basically,
So the last one, these kind of last three are all grouped into one bucket, but the last one is basically the length of your borrowing history. So unfortunately, if you just graduated from high school, you just got a credit card today and you've got 3 months of history, that's going to have, you're not going to be able to start out with a good credit score. So the way credit scores work, just to be clear on that, is you start low and you build up to a high credit score. You don't start with a perfect credit score and then go the other way around, right? So the length of your borrowing history
it's not trust but verify. It's like, no, prove it.
Right.
And this is an important tip I've been told before, is if whatever your oldest credit card is the one that sets the timeline for your length, right?
Correct.
So if you, for example, we have a credit card now that's a free credit card, and we barely ever used the thing, right? My wife specifically, I'm not saying she doesn't understand how this stuff works, but specifically said she wanted to cancel it. Said absolutely not. Like, we've had that card for 12 years. And if we get rid of that, like, the newer credit cards have been around for 2, right? So we don't show as much of an established pattern. Yeah. You know what? In 10 years, I think it's about 7 years to look back, right?
Yeah.
7 years time, great. We'll cancel it then. But if it's costing us nothing, I'm not getting rid of it.
Yeah, that's exactly correct. So if you have a long-standing credit facility, if you don't have other ones, advice in terms of not damaging your credit would be don't close those long-standing facilities, because that will impact you.
And you see that happen when, like, especially maybe in business dealings or whatever it is, someone gets angry with their bank and says, you know what, I'm moving all my business to this location. Great. And, they take their credit cards with them. And suddenly, the line of credit for the business, the credit facilities, credit cards, they're all, fresh and brand new. Right. And that is actually, everything else drops off. And suddenly it's like, well, you actually did a disservice to your credit rating, unfortunately. Yeah. So if we're going to sum up kind of the key, like, what are the key tips you would give an individual to make sure they have a good credit rating? What are the big ones for you?
Yeah, I mean, I think the first thing is being aware. So know what is on your credit report, know the things that are impacting your credit score. I think that's probably the first and most important thing. I think the second thing goes to the very first thing we discussed, because that is the most important. Make sure that you're making your payments on time, right? That is just being diligent with your payments is not just going to help your credit score. It's actually going to help when lenders or other people look at your credit report. Is this someone who's reliable, that I can trust? You mentioned character before. Absolutely. So I think, like, really demonstrating that positive character in many different ways ultimately is gonna benefit your credit score. And then I think the third thing is also checking for errors on your credit file. So we all like to think that our credit reports are perfect and that
they're not.
They're always, like, represented properly. We see so many times where someone says, what do you mean? I've been making all my payments, and there's a line there that says they haven't paid for 90 days. Yeah. So, it is really helpful to check your credit report and credit file just to know, is it actually reflecting what my borrowing history
But even more simpler things, like, especially because when you go to do any of these services, even the ones that directly from there, they always ask you to verify certain information. A number of times I've seen things like, oh, how did you manage to flip my home address with the company I used to work for like 10 years ago? Like, how is this possible, right? Yeah. So they will screw up everything from addresses to facilities to any number of things. So yeah, I think it makes a lot of sense for you to check I would say with actually both facilities. I do this once a year. I actually have it on my calendar, check with both of them, and unfortunately it costs a little bit of money, but whatever it is. But I also think that the great thing about these services like yours is this monthly update I get. I just go in and check and see what the change was month to month. And if someone stole my identity and made all these credit applications, there's going to be notice of that, right? So this is also a way to prevent personal identity theft. And I've had people ask, like, should I be paying for credit monitoring services? I'm like, look, you can do that, but this is free. And if you just check every 30 days, really it's about catching it as fast as possible, right? Yep. So you're more likely to catch it if you just check every 30 days.
Absolutely, yeah.
Anyway, other tips. So before I keep on stealing your thunder here.
Well, I think we covered a lot of them as we were kind of speaking through the different things. But the one, for small business owners specifically, you already brought this up, but when you're thinking about changing financial institutions, this is something that we see really often with small businesses is I've got all my accounts with one and I'm switching everything over to the other. There's a lot of benefits in diversification. So diversifying like who your different credit sources are. So a lot of people think like I'm with this one bank, I'm going to have my lines of credit, my credit cards, like absolutely
it's all on one website. But
right.
Well, you know what the thing is, the banks punish you for that too, because you want to go start with another bank. They're like, well, we don't have a relationship with you. And you're like, I'm trying to start one. You seem uninterested, right? So let's just go over that. Let's just say someone you're sitting across from is currently in the process of changing their corporate bank. Including a credit card there. I mean, like I still have a separate card at Amex, right? That basically does. So that's got a longer credit history. So I'm not hurting myself as much as someone who say had all of their stuff through, say, a bank with a green logo, moving to a bank with a blue logo. It cancels everything. Like that's not as bad, right?
Correct.
Exactly.
That's right. But you can, a lot like, our advice is have different accounts potentially with different banks. So maybe have a credit card with a couple of different bank providers. Yeah. And then there's also a lot of alternative lenders now. Building relationships with alternative lenders actually, again, is a way to build your credit score.
Way to plug your company there. I will give you an endorsement later. So good. A couple last tips before we move on to the corporate one. Anything else?
I think that the other thing that I like to make sure we address to people is don't get too fixated on I have a 680 versus a 720 versus
I'm so guilty of this
705. That's ultimately not the thing that you should be focusing on as a small business owner thinking about your credit scores. Like rather focus on the macro picture of things. So focus on those big things in terms of borrowing history, credit history, the types of loans. If you don't need to get payday loans, don't apply for payday loans. All of those types of borrowing behaviors are ultimately the things that we always stress to people to watch out for, as opposed to the minutia of like if I why did my score go up or down 7 points, because the reality is there's so many
drives me nuts every day. Every time. The number of time, every time, I'm bad at this. I've gamified the entire thing, and I showed you my score, and I'm damn near perfect. And I feel like trying to get to 900 is like Zeno's paradox. You try to move halfway to the wall, you never really get to the wall. And every time I see the thing take a dip, I'm like, what happened? And I go over the report, and I can't tell. And maybe it's just I spent more on the credit card throughout the month, so therefore I was closer to the limit or whatever it might be, right? So it's not worth driving yourself nuts. So let's move on to corporate credit scores. So let's go into, first of all, most people have maybe an idea that they have a corporate credit score, but not necessarily know where to find it or how to look for it. So you've done a great job of providing that for free. So thank you for that. Tell me about what goes into the corporate credit score. How does that differ from the personal one?
Yeah. So there's a few main things that go into the small business or corporate credit score, as the different bureaus give it different names.
Exactly.
But the first is kind of your banking trade lines. So banking trade lines would be things like credit cards, loans, and lines of credit. So those are the first things. And that's very similar to the consumer side of things.
Yeah. So just a diversification of credit utilize or types of facilities.
And all the details on that. So how big the facility is, how old it is, how much you've used of that facility. So again, a lot of the similar things that they would be looking at on the consumer side. The second thing, which is different about business, and you don't get on the consumer side, is industry trade credit. So a lot of providers, suppliers of goods and services actually report into the bureaus as well. And not a lot of small business owners actually know that. So if you're buying lumber from lumber company XYZ and you're paying them later than you're supposed to be paying them.
So
if
you 90-day terms and you pay 95th day, whatever it might be. Yeah.
That actually goes on your business credit profile. So oftentimes, even for a small business, they may only have one or two bank trades, but we'll actually see 10, 15 supplier trades based, depending on the industry that they're in.
Yeah. I mean, it's smart business to basically stretch out those credit terms, right? It's basically, if you have 90 days to pay in the 90th day. I mean, let that money sit, reduce your working capital need. One of the pieces of advice I've seen, given to many companies is, I've given it myself. It's like, well, what are your payment terms? Your payment terms are, your payment terms are 30. How much business are you doing with these people? Call them up and say, look, I think 30 is not enough, and extend it, because, every business owner knows that there's a certain amount of money they have to keep in the company. And part of that's reduced if you don't have to pay, X, Y, and Z for 45 days versus 30 or 60 versus that. And, we've seen a couple of clients who were able to pull six-figure amounts out of the business or redirect that six-figure amount to something else because of the extension of those credit terms. Yeah,
absolutely. I think from a financial and cash flow perspective, we are a business that is focused on cash flow and helping businesses improve their cash flow. So absolutely,
that's the lifeblood of any business, right?
Yeah. So absolutely, that is one of the best ways as a business that you can help to manage your cash flow is stretching out those payables and terms as much as you can. But on the flip side of that, don't go beyond what your agreed upon relationship is. So if they've said, I'm going to give you 60-day terms, don't pay them in 120 days because that's ultimately going to impact your credit. And so why that's important is, if you then want to go borrow money from somebody, they're going to say, well, this is the character of somebody who said that they would pay in 60, but is actually paying in 120.
Yeah. And I mean, like I said 95 versus 90, but let's be realistic. Most people aren't going to necessarily do that, right? They aren't going to necessarily report you in for 5 days. If they are, you're gonna, looking at the report would be helpful to see who you're dealing with and why they're being so harsh. I mean, because everybody can miss by a week. But yeah, as the example of 90, but I'm going to choose to stretch this to 120. Yeah, that's a negotiation you have to make sure you're not violating terms first, right? So that's okay. So that's a difference. What else do we have?
The next factor is firmographic data. So this is actually an interesting one. This is one that a business can't control.
And I have no idea what this is. Continue.
So firmographic data is industry that you're in, years in business. So how long you've been around for, the province that you're in potentially. So there's actually a lot of risk factors in a business that's associated with that firmographic details. And otherwise, if you're a restaurant, you're just frankly a different risk profile. You're just a different risk profile than someone in the financial services industry. And that's just based on historical data. So, there's certain realities there that you can't change. But I think being aware of that is important, because then that's maybe a case where you need to pay even more closer attention to your credit if you're in a higher risk industry.
Interesting. So it's like a demographic. I don't know where the term firmographic came from, but sure. Maybe it was because it was used from farms first. Who knows? So that makes a lot of sense, right? Different businesses, different structures have different risk profiles, especially within the same region. They're going to be affected by the same underlying factors. I mean, good luck to the restaurants out there, and good luck to the cannabis producers. Let's move on. So any other differences?
Yeah. So then the last one that's different than the consumer side is liens. So liens would be if a business has a lien registered against it, that means that they've borrowed. And that borrowing could not necessarily be like a line of credit from a bank. It could even just be like, I borrowed money to buy a car. So I'm financing a car. What usually happens when you finance a car is that the automotive financing company will register what's called a lien, which is a security interest on your business. The more liens you have, again, represents higher risk. So if you've got 25 liens because you've got 15 trucks and 8 cars and you've got 2 credit cards and then you've got a line of credit. Obviously on the one side, that's a lot of credit. On the other side, it's also saying that if I'm going to lend money to you, I'm now behind all of those 25 people.
Right? So everybody gets in line based on when they came in, right? And really it's almost like a list of personal guarantees for a person, but corporately done, right? So it's a list of corporate guarantees, and none of these guys are going to have senior position, right? They just have senior position on each other based on when they came into it, right?
Exactly.
So, okay.
And I'd say like one thing to look out for there is a lot of errors. Like a lot of times, like someone will have borrowed money 5 years ago, paid it back, but that company may not have taken their lien off. They are supposed to, and actually the law says that they're supposed to, but these things happen, right?
Administration and companies don't necessarily want to play with, it also may not be their core business in lending, right? So is there any advantage to trying to, say, pool the number of your different facilities or liens that you have into maybe one larger lien? Or, I think a term structured loan might make more sense, but how's that work?
Yeah. I think, when you're looking at the lien profile of your business, so who has security registered, I think it's more important to, again, be aware of that. So who is my primary lender? Who has like kind of the first security position on my business? And then anyone who else is lending money to my business, make sure that security is actually specific to what they're lending money to you for. So for example, if you're borrowing for a car, really that company should only be registering security against the car. There's no real need for that company to also have security against your business's assets.
Yes, as someone who went through a loan facility application where they literally tried to, I think, almost, put a lien on my children. Yeah, sometimes it's just like, a little bit over, sometimes there's overreach. I think, everybody tries to, they're going to lend you an egg and they want the chicken secured, right? It's a bit much.
I think best example of that in the business space is home equity. So a lot of times we'll see people disguise business loans as it's a business loan, but really I'm giving you a home equity line. So what they're basically doing is just taking security on your personal residence.
Exactly.
And oftentimes you could probably get better terms on that in a non-business capacity.
I know that's the irony. I've seen that before where I remember someone was like, they want to secure, they wanted like 6 points or something like that on this line and for the business. Yet meanwhile, they were using the house as collateral. I'm just like, no, like just take it from the house's home equity line of credit of prime plus 0.5, lend it to your business at the same rate, and it just flows through. And sure enough, that saved them like over 2 points.
Yeah, absolutely. So, I mean, again, just being aware of those things. And if you're borrowing for a business, borrow for the business. If you're borrowing for home improvements, borrow against your house. Like try to keep that separation.
Keep that separate. Yeah.
To the extent possible.
Yes, because make your accountant's life easy, make your, make it, the thing about audits is that when you can prove what you did with paperwork, they tend to go away. When you don't, they tend to look for more stuff. So yeah, I mean, it's, and the good thing is that most of the banks are pretty good about being able to set up sub accounts on lines of credit now. So you can literally say, this 200,000 I borrowed to put in the business, carve that out as a separate sub account, and then you still have the rest of the credit available through a main account.
And then I guess the last area for business owners to be aware of is an area that's also on your personal credit score, but often people overlook that because collections and judgments, as in legal items, are not necessarily too oftenly seen on a personal credit profile. So, on a personal credit profile, collections and judgments do come into play. So if somebody's suing you or if somebody has sent your file to a collections agency, like for example, you haven't been paying your telephone bill, eventually they send it to the collections agency.
Is that a common one? Sorry.
That is probably the most common one that we ever see.
Yes. Well, it's interesting. So I had a conflict with a telephone carrier that shall not be named, but basically is the biggest one in the country. And they tried to stick me with this fee on when I left them. And luckily I know enough people at that company that this thing disappeared. But before that happened, they had passed along the file to a credit, they had syndicated the credit, right? Yeah. So for years now, every couple of years, someone else will buy that list and call me up saying I owe the money. I'm like, you show me all the evidence and that'll happen. But I can tell you right now, if I contact Bell, they wrote that off. So you bought a useless line on a spreadsheet, my friend. And the conversation ends right there.
For sure.
Yeah.
So, on a personal side, again, things to watch out for, but they're a lot more common from a business perspective. Judgments happen a lot more often in the business side of things. If somebody slips and falls on your premises, they file a lawsuit against you. Oftentimes your insurance hopefully will cover that, but it's still showing up on your business.
Yes, this isn't something this is not you deciding to stick it to a supplier because you have a conflict. This is just, someone's basically going after your business for whatever reason, right? And again, it could be a slip and fall, it could be a disgruntled employee, it could be any number of things, right? And this is welcome to the risk of business, right? Like if you wanted an easy life, I'm not going to make a comment about government work, but continue on. So and no one listening to this podcast believe for 1 second that they picked the easy option.
No, definitely not.
No, exactly. So, okay. Anything else they should know in the space?
No, I think those are probably the last two. Excellent. When it comes to business credit.
So let's just reaffirm. So the website to get this is getloop.ca, right? So free credit score, your person and your business, you can track that over time. There's some recommendations. And then we'll talk about your core business now, because that is also something that would be of massive value to small business owners. And I can say I've personally used your product, so I can literally endorse it. And I'm going to let you talk about it first, and I can talk about some of the nice things I like in my experience.
Yeah, absolutely. So our core business is Lending Loop. So Lending Loop, like you mentioned, is an online lending platform. It's actually the first of its kind in Canada. We are a regulated entity that's essentially allowed to match businesses looking for capital within individuals who want to lend money to businesses. So individuals being people like yourself and myself who have some extra capital that they want to deploy, and they put it into small businesses. So a small business owner could, in theory, be either a lender or a borrower on our platform. Now, the real benefit for businesses is we wanted to create a loan product that looks quite similar to a traditional loan product that you would look to get from a bank. But the real difference with that loan product is that it is tied specifically to your business. So we're not the provider that's got all of your accounts and your credit cards. Like we are truly a separate and standalone product.
You're just kind of, you're facilitating the transaction.
Yeah. And what that allows businesses to do is actually start to build a business credit profile, because a lot of business owners, when they get started, will either borrow against their personal home equity, or they'll borrow on personal credit cards. And that actually doesn't necessarily benefit their business credit. So believe it or not, that just benefits their personal credit.
And the banks can be pretty ridiculous on this note. I mean, they literally, personal experience, myself and other clients, they do not take any risk on this sort of thing, right? I mean, the honest truth is the only reason they give you multiples of your down payment for your home is because there's collateral and it's insured. But when it comes to your business, like people have asked me, like if I gave them like 100,000, when I get back, I'm like 100,000, your 100,000 would be lent back to you. Like, that doesn't make any sense. It's like, no, you don't understand. This is where collateral matters more than anything is in business, right? And I'm sure many people listening, this is no surprise. But I mean, only banks in Canada would come up with the concept of, here's an idea, give us 200,000, put it in a GIC, and then we'll give you a line of credit for 200,000. To which I remember when I was told, I'm like, let me get this straight. You want to lend me $200,000 at 6%, guaranteed by my 200,000 earning 1.5%. Like, do you think I suffered a massive head injury that I can't do that kind of math? I'm like, yeah, but that helps establish a credit pattern. I said, that helps me lose money. So I'm basically paying you for the privilege for abusing my own money. I think not, right? Like this is, so frankly, the difficulty in establishing a small business credit history from lending from major facilities is pretty difficult, quite honestly, right? So you're providing a facility for that.
Yeah. So, again, going back to that, as a business owner, we're giving you an opportunity to basically access an affordable source of capital to help your business grow, to do what it needs to do, whether it's working capital, expansion, renovation, all of those types of, we basically fund businesses for almost any use case. And then what that's also helping, tying that into credit, is starting to establish business credit for a business. And that's why we built the GetLoop platform, what getloop.ca is. We wanted to kind of create that close alignment between understanding credit and business loans, right? There's a very close alignment, especially for a business owner who may not have ever borrowed from a large financial institution in the past. We're really giving that opportunity to establish your first sources of financing. So we're giving you that educational information, helping you understand what your scores are, the things that you can do to impact your scores or change those scores. And then with that, then offering financial products that can actually help you at the end of the day. Absolutely. So great, I know what my credit score is, but really at the end of the day, how we can help a business owner is by saying, your credit score is this is how you can improve it. And also if you're looking for capital, this is how you can get capital.
So, I mean, you provide two things. You provide an avenue for investment of their money that maybe, they can tie up for a while, but more importantly to them, you provide access to capital. So talk to me about the process, because this is one of the things that I thought was the best part of what you guys did. Because anyone who's ever, tried to get a loan from a bank or from any other private facility, how painful that can be. Tell me about how you basically onboard people or just provide them with information on quotes.
Yeah, it's a very simple process. So to start off, there's an online loan application at lendingloop.ca. You go in and you can basically complete a full loan application in about 5 to 10 minutes. From there, you provide us with some basic information. So that information is typically just your bank data and your financial data. And then what we're able to do with that is essentially within 2 business days, turn around a loan offer for you. So as a business owner, from about 2 business days from when you come to us, you can actually have an offer for financing, which is an incredibly, quick, easy, and efficient process for a business owner. And that's really what we're all about, is saving business owners time and money. We know that's the most important thing for a small business owner that's building a business. So what we want to do is make the process of applying really easy, make the process of getting an offer really easy, and ultimately, if you want the funding, getting the funding really easy as well.
And you contrast that to the owner of the bank where, you're 2 days, you give them the information, I could get back to you for God knows how long, but it's not like you're not being diligent, right? So you've used leverage technology in order to basically be able to turn around that quote. So what are you doing in order to understand the client so that you can offer them that kind of loan? We've
built our own kind of proprietary risk models. And what those allow us to do is very quickly and efficiently adjudicate the risk of a business, right? So we look at things like the credit scores that we spoke about earlier, but then we also look at hundreds of different data sources on the business to basically understand for a business, what is the risk associated with this company. And using all of these data sources, so these are online data sources, offline data sources.
Including you link to their bank account and pull the transaction history. You can link to their accounting software, right? So the same kind of things that the bank is asking you for, but you're pulling it with a couple of logins.
So, for a business, there's no rummaging around, going to an accountant, asking them for, information, getting it in paper, bringing it into a branch. There's literally, the process of providing that data to us is literally 2 clicks. It's literally 2 clicks. And from there, we have the data, and then we can then give you an offer financing based off that data. So it makes the process efficient both for the business owner and for us too.
Absolutely. And that's one of the things I appreciate the most. I mean, before the bank could even tell me if they were looking at you, told me that here's what it is and here's the rate, right? It's like, great, I'm shopping this around, but I'll get back to you and let you know what comes back. And sure enough, 5 days later, the other people get back to me, even though they had a 5-day head start, right? So it is what it is. So what size loans are you doing right now?
Yeah, so we do loans anywhere from $5,000 up to $500,000.
Okay.
So that's the loan ranges that we're currently doing. And then, in terms of what the loan product looks like, it's a term loan. So that means that you're repaying both principal and interest on a monthly basis. And then that loan term can range anywhere from 3 months all the way up to 5 years. And that kind of depends on the business owner's preferences.
Excellent. And talk to me about the rates. How do they compare to what a bank would offer?
Yeah. So our rates, we're very transparent with all of our rates. That's really kind of one of the key ways that we like to do business is through transparency. So our interest rates range from 5.9% to 26.5% on the high end. The only other fee that a business will ever pay is an origination fee. So that origination fee ranges from 3 to 6.5%.
Yeah.
Now, that fee of 3 to 6.5% may sound high, but I think the really interesting thing that we like to educate people on is if you go and get a facility from a commercial bank, typically the fee that you're going to pay is a review fee, a setup fee, a monthly review fee, and then an annual underwriting fee. So when you add all those fees up, it looks like it's cheaper, but at the end of the day, you're actually paying a lot more than a flat 5% fee.
Yeah, I remember someone was like, wow, we're paying this much up front. I'm like, yeah, versus death by 1,000 cuts, right? I much prefer that kind of transparency. So, I mean, and at the end of the day, what you're doing, once this is approved, it goes on your marketplace, right? And for, essentially this is a crowdsourced play, right? So investors from all over the place can go on, look at the different loans and choose to lend this client's business money.
Yep.
So basically tell me about how much or how little an individual can lend. I see company ABC, I want to lend money to it. What kind of information am I seeing? How much or how little can I put in?
Yeah. So increasingly kind of the way that investors are investing through our platform is through a tool that we built called AutoLend, which essentially is automated lending. So what we're really trying to make sure that investors do when they invest in businesses is diversify that portfolio. So that means instead of investing $10,000 in one business, invest $100 in 100 different businesses.
Yeah.
So that's
diversification. There you go.
So that's how the vast majority of investors do it. And so they just come into our platform, they kind of set their risk preferences. So they say, high risk, medium risk, low risk. And based on that, our software basically builds a loan portfolio for that investor. So what that does for a business is also makes the process of raising capital very efficient because you don't have to wait for investors to come look at the different opportunities that are available and see your business, decide whether or not they like your business and decide whether or not to invest. So that's the predominant way today that people are investing money through Lending Loop.
I just turned that on, by the way. I didn't have that on.
If a business or an investor wants to invest in a specific business, they can actually go onto our platform and look at specific companies that are looking for capital and invest that way as well. So they can go and look at who the business is, what they do. The business owner can write a couple of sentences as a brief description of that loan. And then, let's say you're a yoga studio and I'm a yoga fanatic. I can go and invest in your yoga
studio. You can actually lend money to businesses, I mean, and more often than not, I mean, when I did this in the past, I'm a financial advisor, so I can't actually let clients know. Like it's a conflict, right? But there were friends within the industry who were also financial advisors, like, you're borrowing money at what rate? I'll totally lend you money, right? So they were informed investors. That was not an issue. But, for the average consumer, average user of this, they can tell their friends and family, hey, I'm raising money to fund the business, blah, blah, blah. You can participate this. I think we'd all rather pay interest to people we know than people we don't, right?
Absolutely,
that being said, people we don't want the money, then so be it, right? So frankly, I think you put together a very lovely service because I've used it in the past. I've recommended it to clients in the past, and they've been very exceedingly happy with it. And one of the other things I wanted to touch upon before we finish this up is your proprietary risk score. And I think this is a story that needs some attention. So you put together a picture, a risk score of the client base versus what a conventional lender would look at, which is, basically your credit rating. How does that compare? Are you lending to people that otherwise would be passed up by other lenders because you have a better view of them, or how's that working?
Yes, absolutely. So, when you think about, I think this is the classic example to help put this into perspective, is the most common thing we see is a business owner has bad personal credit because they've been borrowing on their personal credit cards since they started their business, right? And that's understandable. That was the easiest and most available source of credit to a business. And so as a result, their utilization has been close to 100%.
Right? All the credit card, that's for sure. Yeah.
So they've been maxing out all of their credit facilities and they have a bad credit score. So if a traditional lender would usually look at that person and say, a bad credit score, high utilization, rejected.
Yeah.
What we do is we take all of the different factors into consideration and kind of build one consolidated picture. So, okay, sure, you've got high credit utilization. However, your business is generating strong cash flow. You've been growing every single year. You're a business that looks like I would want to lend to you. I'm going to actually give you more credit for the fact you have a good business than the fact that you've been borrowing a lot on your credit cards. Yep. And I think that is really the philosophy that we've approached how we evaluate business risk. Is it's not about just the business or just the consumer, because when you're starting a business, it's kind of one thing. Mm-hmm. So we really try to evaluate the overall picture by bringing into play, what is your consumer risk? What is your consumer credit behavior? What's your business risk and business credit behavior? And using that combined factor, we can then go and say, okay, you know what? Despite the fact that their personal credit profile says one thing, we actually believe that they're a good credit risk and we can lend money to them. And I think that's really how we're trying to change the way that people look at small business credit.
And this is a bigger and bigger issue because, anyone who's been through this knows that essentially small business banking is something different than the next level, which is commercial banking, right? Yeah. Commercial banking at a certain level, they will take the time to fully understand your business inside and out, similar to what you're talking about. You can sit down across from them, explain, this is an exceptional item. This is what happened to me this year. They typically understand that sort of thing because they've seen complexity like that before, and they make a more informed decision. The problem is the thresholds for getting to commercial banking and just keep on going up and up and up, right? And the rest of us, and myself included, struggle sometimes because, whereas I've talked to commercial bankers like, oh yeah, we take your deal in a heartbeat, but you're too small. We have to send you to small business banking. And then next thing you know, you'll go small business banking and they're working off a checklist, right? And that checklist, guess what? You don't hit that checkbox, sorry, nothing I can do for you. So, having alternatives such as yourselves, which are basically, frankly, moving into a space that the banks are not as interested as moving in, are moving out of, frankly, or making it harder for because they're trying to squeeze whatever margin they can out of it, is useful. So thank you for that. Because again, personally used, personally endorsed, and I've had clients do the same thing and utilize your services to much acclaim. So Cato, this was great. I hope everybody learned a lot about credit scores today and about an alternative lender. In addition to that, so let's just talk about, we talked about Get Looped. So what is your main business? Where can I find you? Yeah.
So, I would say if you're a business owner looking to understand more information about your credit score, I would go to getloop.ca because that's really where you're going to get that education on what your credit scores look like. Yeah. And through that platform, you can then understand what are the things that you can do to improve your credit. So we've got resources and tools like webinars or email courses on steps that you can take to improve your credit. And sometimes that's actually personalized to a business. So I'd say if you're looking to understand that information, go to getloop.ca, completely free, and sign up there. Through GetLoop, if you're then interested in borrowing, if you're qualified for a loan from us, you'll see a recommendation to get a loan from Lending Loop. And what we do there is we actually look through your credit profile, and then we only recommend Lending Loop if you're actually qualified to borrow from us. So that really creates a more seamless experience for a business owner. So if you focus on credit scores, focusing on understanding your financial information, go to getloop.ca, check out your information. And then if you're interested in borrowing, get to lendingloop.ca.
Fantastic. Cato, thank you for your time.
Appreciate it. Thanks for having me.
So that was my interview with Cato Pastoll of Lending Loop. I hope you enjoyed that. I hope you take the time to sign up for his website, specifically Get Loop, so that you receive your monthly free credit reports, both personally and corporately, and just be aware of what they are. And hopefully, like me, obsess about them just a little bit and try to make them better. I would also encourage you that if you're looking for lending, please check out his site. I'm not just doing it as an advertisement. And most certainly, this is not a paid advertisement. I take no compensation, but I have used his service and it was much better than my conventional experiences. So as always, this has been Jason Pereira, and this is the Financial Planning for Canadian Business Owners podcast. And if you enjoyed this podcast, please leave a review on Apple Podcasts, Stitcher, Google Play, or wherever it is you get your podcasts. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals, business owners, and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on Apple Podcast, Stitcher, Google Play, Spotify, and SoundCloud. For more episodes, go to jasonpereira.ca. You can even ask Siri, Alexa, or Google Home to subscribe for you.